Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we're jumping right into one of the most talked about and honestly most misunderstood topics out there, Bitcoin. We're going to pull back the curtain on the big idea behind it, how the machine actually works, and tackle that million-dollar question. What, if anything, gives it value?
It all starts right here. The Times, 03/Jan 2009, Chancellor on brink of second bailout for banks. Now this isn't just some random quote. This single sentence, left by Bitcoin's mysterious creator, Satoshi Nakamoto, is pretty much the key to understanding the entire reason Bitcoin even exists.
You see, this message wasn't just a comment scribbled in the margins. It's literally coded into Bitcoin's Genesis block, the very first digital brick in the entire foundation, where it will stay forever. It's a direct, permanent timestamp pointing straight at the 2008 financial crisis, a clear signal that Bitcoin was born as a response to a system that, in Satoshi's view, was broken.
So, to really get our heads around this, we're going to break it down into three parts. First, we'll dig into the genesis, the why behind it all. Then we'll look at the machine, the incredible technology that makes it run. And finally, we'll get to the value, the big question on everyone's mind.
So, what was the real problem Bitcoin was designed to solve? Well, it boils down to this phrase, a response to reckless money printing. Let's take a look at the data to see what that actually means.
This chart right here really tells the story. What you're looking at are the total assets held by the U.S. Federal Reserve. See that insane, almost vertical spike right around 2008? That is a massive, unprecedented expansion of the money supply. It's the very money printing that had Bitcoin's creator so concerned.
And this is the other side of that coin, the U.S. debt clock. In the traditional financial world, when that kind of money expansion happens, it means governments are basically writing checks that future generations, us, our kids, will have to pay for, one way or another.
Bitcoin's solution to all this was both radical and incredibly simple. A currency with a hard, unbreakable limit, 21 million. That's it. There will only ever be 21 million Bitcoin. No government, no bank, nobody can ever push a button and create more. It's designed to be immune to that kind of inflation.
Okay, a finite currency is a cool idea, right? But how on earth do you build a system to manage it when there's no bank or government in charge? This is where we get into the pure genius of the machine itself. And a great way to understand it is by unpacking something called the blockchain trilemma. So, at the very core of Bitcoin, you have this thing called an immutable ledger. The easiest way to think of it is like a shared digital notebook. A copy of this notebook exists on thousands of computers all over the world. And once a transaction is written in it, it can never be erased or changed. It's there for good. And this brings us to the giant engineering puzzle that every single cryptocurrency has to solve. How do you build a system that's fast, incredibly secure, and completely decentralized with no one in charge? This puzzle has a name, the blockchain trilemma. The theory basically says you can pick 2 out of 3. Scalability, which is just a fancy word for speed, security, and decentralization. Getting all 3 to work perfectly at the same time is the holy grail, and it's incredibly difficult. You usually have to make a trade-off. And this slide lays out Bitcoin's choice crystal clear. Bitcoin can handle about 7 transactions a second. Meanwhile, a centralized system like Visa, it can do up to 24,000. So Bitcoin made a very deliberate choice. It sacrificed speed to be as secure and decentralized as humanly possible. And that has huge implications. It's not great for buying coffee, but it's fantastic if you're trying to build something incredibly robust. So how does it stay secure? Through a process called proof of work, which you've probably heard of as mining. Just think of it like a massive global competition where supercomputers are all racing to solve a really hard math problem. The winner gets to add the next page to that digital notebook. It uses a ton of energy, for sure, but that's also what makes it so secure. It would be ridiculously expensive to try and attack it. This is totally different from newer models like proof of stake, which rely more on economic incentives than on raw computer power.
And that brings us to the question I know you've been waiting for, the value. If it's not backed by a government or a pile of gold in a vault, what is a Bitcoin actually worth? Let's walk through a few ways people are trying to figure that out.
One of the most common ways to think about it is as digital gold. And you can see why. Just like gold, it's got a limited supply and people all over the world accept it. But here's the kicker. Portability. It's a whole lot easier to send $1 million worth of Bitcoin across the planet than it is to ship $1 million worth of gold bars. Now here's another really fascinating angle. Its production cost. This chart is pretty amazing. It shows that, over time, Bitcoin's price has tended to follow its production value. That's the real-world cost in electricity and computer hardware it takes to create it. So, when the market price dips below that cost, it becomes unprofitable for some miners to keep going. They turn off their machines, supply gets tighter, and that often creates a kind of natural price floor. This whole idea really grabbed the attention of the legendary investor Paul Tudor Jones. He actually made this scorecard, ranking different assets based on things like trust, portability, and so on. And what blew his mind wasn't that Bitcoin came in last. It was how close it was. He literally said, "Something appears wrong here, and my guess is it is the price of Bitcoin." He pointed out that Bitcoin scored about 66% as well as gold on his framework, but its total value was just a tiny fraction of gold's, about 1/60th at the time. To him, that smelled like a huge opportunity. So, let's just tie this all together. Bitcoin wasn't just some random invention. It was a direct answer to the 2008 financial crisis. Its technology makes a very clear trade-off. It chooses security and decentralization over speed every single time. And while it's tricky to value, we're seeing real frameworks emerge, like comparing it to digital gold or looking at its cost to produce. And that leaves us with the big open question that the entire world is still wrestling with. Is this thing the future of money? A new kind of digital gold? Or is it just a really fascinating, world-changing experiment? The jury is still out.
You know, every great story has a beginning, but Bitcoin's, it's a total mystery. It didn't just pop up out of nowhere. It was launched with a very clear purpose and a secret message hidden in its very first lines of code. So let's dig in and uncover what the birth of Bitcoin was really all about.
It all kicks off with this message, left by Bitcoin's totally anonymous creator, some person or maybe even a group of people, known only as Satoshi Nakamoto. Now, this wasn't just some random headline they pulled out of a hat. No way. This exact text from the front page of the Times of London on January 3, 2009 was a powerful and very deliberate statement. In fact, it's kind of the key to understanding why Bitcoin was even created in the first place.
So where did Satoshi hide this little bombshell? Not in some blog post or an email. It was permanently burned into the raw code of the very first block of Bitcoin, what's known as the Genesis block. It's baked right into its digital DNA. It can never be changed.
So that's the big question, right? Why this specific message? Why would you embed a critique of the entire banking system into the foundation of a brand new kind of digital money?
To get that, we have to talk about the creator. The thing is, we have no idea who Satoshi Nakamoto really is. Their identity has never been revealed. This one unknown person or group launched this world-changing financial system and then just vanished. Never even claimed the incredible wealth they created.
So while the who is a complete mystery, the why is actually pretty obvious. That message points directly to the financial crisis of 2008.
To really get the context, just look at this chart. It shows the total assets held by the U.S. Federal Reserve. See that massive, almost vertical spike right around 2008? That right there is what an enormous amount of money printing to fund bank bailouts looks like on a graph.
The main takeaway here is that Bitcoin wasn't born in a vacuum. It was a direct, pointed response to governments covering the massive losses of private banks and then passing that cost on to regular citizens through taxes and what Satoshi clearly saw as just reckless money printing.
The existing system, as this chaotic U.S. debt clock shows, is this unbelievably complex web of debt. Bitcoin was designed to be a radical alternative, almost like an escape hatch from a system where money itself is fundamentally created as debt. And here is the alternative. In stark contrast to the endless printing of money we're used to, Bitcoin's supply is absolutely finite. There will only ever be 21 million Bitcoin. That's it. No government can just decide to print more to bail out a corporation. This number is the heart of its entire value proposition.
Satoshi laid this all out in the original Bitcoin white paper. The whole goal was to build a system where you didn't have to trust big financial institutions. Instead, it would all be based on pure mathematics, on cryptographic proof, which really just means trust is replaced by code that anyone can verify.
This diagram from that same white paper shows the vision perfectly. In the traditional model, you've got a trusted third party, like a bank, sitting right in the middle of every single transaction. Bitcoin's model? It just cuts them out completely. It lets any two people deal directly with each other, peer-to-peer.
Okay, so how can you possibly have a financial system without a central authority keeping track of everything? Well, the answer lies in a whole new kind of accounting book.
It's called an immutable ledger, which you probably know by its other name, the blockchain. Think of it like a digital stone tablet. Once a transaction is carved into it, it's there forever. It can't be changed. This gives you security without needing a bank to vouch for it.
There's a great analogy for how this works. Imagine a professor's master lecture notes. That one central record gets stolen. Total disaster, right? But what if all 100 students in the class combine their individual notes? They could reconstruct the original. And if there are any disagreements between their notes, they can just vote to confirm the true version. The information is safe because it was distributed, not centralized.
Well, in the Bitcoin network, those students are called miners. They're using powerful computers to validate all the transactions and add them to the public ledger. This massive computational effort, what we call mining, is what keeps the entire record secure and consistent. It's like hundreds of thousands of students all checking each other's work at the same time.
But here's the thing, designing a system like this involves some pretty fundamental compromises. You really can't have everything, and Bitcoin's creator had to make a very specific and very important choice.
This is known as the blockchain trilemma. Basically, it says that it's extremely difficult for a blockchain to achieve all three of these properties at the same time. You typically have to sacrifice one to get really good at the other two.
So the three competing pillars are decentralization, which means no one is in charge, security, which is all about protecting the ledger from being corrupted, and scalability, which is really just about transaction speed.
So how does Bitcoin stack up on scalability? Well, take a look at this. VSIC can process up to 24,000 transactions every single second. Bitcoin, on the other hand, can handle about 7. Yeah, 7. That is a truly staggering difference.
So why would anyone build a payment network that is literally thousands of times slower than the existing system? Because that slowness, it's not a flaw, it's a choice.
And this is the core trade-off. Bitcoin intentionally sacrifices speed in order to be as secure and as decentralized as humanly possible. For Satoshi, security and decentralization were the whole point. Everything else was secondary.
This map shows you what that decentralization looks like in the real world. Each one of these little dots represents a node. Think of it as one of those students with a notebook, all helping to maintain the ledger. This global distribution is what makes the network so incredibly resilient. It's almost impossible for any single government or organization to attack it or shut it down. Which leaves us with one final thought. From a simple message protesting bank bailouts, a system was born that prized security above everything else. But we live in a world that increasingly demands both speed and efficiency. That original choice presents a fundamental challenge. So the question is, what comes next?
Welcome to The Explainer. Today, we're going to break down how Bitcoin really works from the ground up.
Okay, so let's start with that quote. The most important invention since the internet. I mean, that's a huge claim from Roger Ver, right? It really gets at the wild excitement around this tech. But what's actually making it so revolutionary? Well, to figure that out, we've got to look under the hood.
And you know, at the very heart of Bitcoin, there's a piece of tech that honestly is arguably even more important than the currency itself, and that is the blockchain.
Okay, so what is a blockchain? The easiest way to think about it is like a shared digital checkbook that literally everyone can see. Every single time a transaction happens, it gets written down. But here's the kicker. Instead of one person or one bank holding that book, thousands of people all get an identical, constantly updated copy. These copies are spread out on computers all over the world. We call them nodes. And that, right there, is the core idea of decentralization.
And this is where the real magic happens. So what if a hacker tries to sneak in and change the record on just one of those computers? Well, the rest of the network, all those thousands of other people holding the correct copies, they're going to instantly spot the difference. They'll just reject that fake version. It's this powerful group agreement, this consensus, that keeps the whole system honest. It's brilliant, really.
Okay, but that raises a big question, doesn't it? What if someone tries to cheat on a massive scale? I mean, if this network is totally open for anyone to join, what's stopping some bad actor from just creating like thousands of fake identities and trying to overpower all the honest people?
Well, there's a name for that. It's called a Sybil attack. And in the crypto world, the version everyone's terrified of is the 51% attack. That's where somebody tries to grab control of more than half the network's power. And if they pull it off, oh man, they could block transactions or even worse, spend the same coins twice. Big trouble.
So, how does Bitcoin stop that from happening? How does it protect itself? Well, Bitcoin's mysterious creator, Satoshi Nakamoto, actually saw this problem coming from a mile away. And the solution wasn't to build a higher wall. No, the idea was to make attacking that wall just ridiculously, unbelievably expensive.
And the way they do it is by making sure anyone who wants to participate has some skin in the game. There has to be a real-world cost to play along. So, by making it expensive just to add new transactions to the ledger, it becomes astronomically expensive for any one person or group to try and launch an attack.
Okay, so this whole idea of a cost of participation, that's what brings us to the two major ways cryptocurrencies keep themselves secure today: proof of work and proof of stake. Let's start with the OG, the one Bitcoin is famous for.
This right here, this is Bitcoin's big innovation. Think of it like a giant global Sudoku competition that never ends. You have miners all over the world using these super powerful, specialized computers, and they're all racing to be the first one to solve an insanely difficult math puzzle. All that brain power, that computational effort, that's the work. And the winner? They get to add the next block of transactions to the chain. And for all that hard work, they get rewarded with brand new Bitcoin.
But all that work requires a truly mind-boggling amount of energy. We're talking an estimated 150 terawatt-hours of electricity every single year for the Bitcoin network.
So to put that in perspective for you, that's more electricity than the entire country of Argentina uses. And yeah, this is without a doubt the #1 criticism of proof of work. But, and this is so important to understand, that massive energy bill is the security feature. It's not a bug, it's the point. To attack the network, you'd have to spend more on power and computers than all the other miners in the world combined. It just makes it completely irrational economically to even try to cheat. The system is literally protecting itself with raw economic force.
Now, because of that energy issue, a major alternative popped up: proof of stake. And it changes the game completely. Instead of proving you've done a bunch of work, you prove you have an economic stake in the system. It works like this. Validators lock up a chunk of their own crypto as collateral. They stake it. Then, the network randomly picks one of them to create the next block. The more you have staked, the higher your odds of getting picked. Simple as that.
So this table does a great job of laying out the trade-offs. Just look at the equipment row, for example. Proof of work, you need crazy expensive, specialized hardware. But with proof of stake, a pretty standard server can get the job done. And that, of course, has a huge impact on efficiency, making POS way more energy-friendly. But then the attack vector, how you'd attack the system, changes. For POW, you need 51% of the world's computing power, a massive, physical, energy-sucking challenge. For POS, you need 51% of all the coins on the network. That's a huge financial hurdle for sure, but it does raise questions about whether power could end up concentrated with the wealthiest people.
And look, proof of work and proof of stake, they're the big two, but they are definitely not the only games in town. There's a whole universe of different ways these networks can agree on things, what we call consensus mechanisms. Each one is trying to find that perfect sweet spot between security, speed, and decentralization.
So let's bring this back to you. In this decentralized world, there's no big company, no bank in charge. So what does that actually mean for you as a user? Well, it means you are the bank. And that means security is 100% your responsibility. Okay, so when it comes to storing your crypto, you basically have two main choices. On one side, you've got hot wallets. These are things like apps on your phone or your account on an exchange. They're always connected to the internet, super convenient for trading and making quick transactions. On the other side, you have cold wallets. These are actual physical devices, kind of like a special USB stick, that you keep completely offline. Think of it like a digital vault. And the absolute key difference here is who controls the private keys. That's the secret password to your funds. With a cold wallet, you and only you are in control.
And listen, I really can't stress this enough. In the world of Bitcoin, there is no forgot my password button. There is no 1-800 number you can call if you accidentally send your money to the wrong address. There is no one who can help you if you lose your device. All those stories you hear about people losing millions of dollars worth of Bitcoin on an old hard drive they threw away, they are absolutely real. The responsibility is 100% on you.
And all of this brings us right back to the core dilemma, doesn't it? Bitcoin created this totally new kind of digital trust, one that doesn't need a government or a big corporation to back it up. But it's a trust that is literally forged in fire, powered by a massive amount of energy. So as this technology keeps evolving, the big question we're all left with is the price of that digital trust just too high?
Welcome to The Explainer. Today, we're tackling one of the biggest, most confusing questions in all of finance. How much is one Bitcoin really worth? And I'm not talking about the day-to-day price swings. We're going to go on a quest to find its fundamental underlying value. You know, this Oscar Wilde's quote, it just hits the nail on the head when it comes to Bitcoin, doesn't it? The price is everywhere, flashing on our screens 24/7. But the value? Well, that's the real mystery, and it's at the center of some of the fiercest debates happening right now. So how do we do it? How do we look past that noisy price ticker and actually find the real value? Well, to figure that out, we're going to explore this whole puzzle through 3 totally different lenses that analysts use to try and pin down what a Bitcoin is fundamentally worth. Okay, first up, lens number 1. This is the big one you've probably heard a million times, the idea of Bitcoin as digital gold. And when you put them side by side, the comparison is pretty compelling. Think about gold, right? It's valuable because it's scarce, it's a pain to mine, and pretty much everyone agrees it's worth something. Now look at Bitcoin. Fixed supply? Check. Only 21 million ever. Costly to mine? Oh yeah, that takes a ton of energy. Portable and global? Absolutely. The bottom line is, they both act as this kind of store of value that's completely outside the control of any single government. Now, there's actually a way to put a number on this scarcity. It's a model called stock to flow, and the idea behind it is actually pretty simple. You just look at how much of something already exists, that's the stock, and you compare it to how much new stuff is being created each year, that's the flow. The higher that ratio, the scarcer, and theoretically, the more valuable the asset is. And here's the wild part. For years, this model was scarily accurate. I mean, just look at this chart. You're seeing the model's prediction right on top of Bitcoin's actual price. The 2 lines were practically glued together for a long, long time. And as you can imagine, this got a ton of people really, really excited. But, and there's always a but with financial models, right? They are not crystal balls. As this tweet from Ethereum founder Vitalik Buterin points out, the model kind of fell apart recently. He makes a great point here that these models that give you this false sense of certainty can actually be pretty dangerous. It's a perfect reminder that you can't just hang your hat on one single way of looking at things. Okay, so that was lens 1. Let's switch gears completely now for lens number 2. What if we stop thinking about Bitcoin as digital gold and start treating it more like a traditional financial asset? You know, like a stock in a company. So, with stocks, everyone knows about the PE ratio, right? Price to earnings. It helps you see if a stock is cheap or expensive. But Bitcoin doesn't have earnings, so what do? Well, analysts got creative and came up with the NVT ratio. You can think of it as the PE ratio for crypto. It compares Bitcoin's total value, the price, to all the money moving around on its network, its economic earnings. It's a really clever way to ask, is the price justified by how much people are actually using it? This is really cool. The legendary investor Paul Tudor Jones actually made a scorecard for this stuff. He ranked different assets on qualities like trust, portability, and so on. And yeah, Bitcoin came in last, no big surprise. But here's what blew him away. It still scored almost 60% as high as traditional financial assets, even though its total market value was just a tiny, tiny fraction of theirs. To him, that huge gap was a signal, suggesting a massive potential for growth. And this image, wow, it just drives that point home, doesn't it? Just look at the size of these markets. Gold, stocks, bonds, they are absolutely enormous. And then you see all of crypto, it's just that little tiny dot in comparison. So the argument here is pretty straightforward. If Bitcoin can just capture a small piece of these other giant markets, well, its value has a long, long way it could grow. All right, time for our third and final lens, and this one's different. Forget about gold, forget about stocks for a second. With this lens, we're looking at Bitcoin as a pure technology network. So think of it just like the early internet. And this whole idea is built on something called Metcalfe's law. Now, it sounds complicated, but the concept is amazing. It basically says that a network's value doesn't just add up, it multiplies. It grows exponentially. So every new person that joins the network doesn't just add a little bit of value, they make the entire network more valuable for everyone already on it. The classic example is the fax machine. It's perfect. Imagine you have the very first fax machine in the world. What's it worth? Absolutely nothing, right? Here you're going to fax. But then someone else gets one. Suddenly, your worthless box has value. Now imagine 1,000,000 of them, and boom, you've got a technology that changed the world. Every single new user makes the whole thing more powerful. Okay, so let's bring this back to Bitcoin. If Metcalfe's law is the key, then the thing to watch is user adoption. And this chart, well, it's pretty mind-blowing. It's comparing the adoption of crypto to the adoption of the internet back in its early days. And look at that curve. Crypto adoption is happening even faster. So if that law holds true, this explosive growth in users could be the single most powerful driver of Bitcoin's long-term value. All right, so we've looked through 3 totally different lenses, right? Digital gold, a financial asset, and a tech network. After all that, what's the takeaway? What do we actually find on this quest for value? Well, what we've seen is that each lens is really telling a different story or making a different kind of bet. The digital gold story, that's a bet on scarcity. The financial asset story, that's a bet that Bitcoin will steal a slice of the pie from much bigger markets. And the network story, that's a straight-up bet on exponential user growth. 3 totally different paths to potential value. So the biggest takeaway here is there's no single magic formula. There isn't one model that just spits out the right answer. The real understanding comes from looking at it from all these different angles at once. But that leaves us with one final huge question, doesn't it? All of these models are based on the past. But for a technology that's trying to define a completely new future, what will the next model for valuing it even look like? Have you ever looked at a stock chart and just seen, well, chaos? A jumble of lines going up and down. The big question we're tackling today is this. Is all that movement truly random, or is there a hidden rhythm, a kind of rhyme, hiding in all that noise? You know, Mark Twain probably wasn't day trading when he came up with this, but man, does it hit the nail on the head for price analysis. See, we're not looking for the market to do the exact same thing over and over. Instead, we're searching for those familiar patterns, those rhymes that give us a hint about what might be coming next. And that really is the million-dollar question, isn't it? Think about it. For every single person selling a stock, there's someone on the other side buying it, and they're both absolutely convinced they're making the right call. So, where do we even begin to build a framework for this? Well, we have to start by looking at the biggest obstacle of all, ourselves. Right, because while the market looks like it's all about numbers and data, what it's really driven by is something way more unpredictable: human emotion, our own feelings, fear, greed, hope. They can be our absolute worst financial advisors, pushing us to do exactly the wrong thing at exactly the wrong time. Sound familiar? We've all been there. A stock is dropping and we start bargaining with it. Just pop up a little bit and I promise I'll get out. It's this classic mix of denial and hope, a totally human reaction that usually happens right before things get even worse. And then, of course, you've got the flip side. When a stock is just skyrocketing, that excitement is electric, it's contagious, you feel like a genius, you feel invincible, and that little voice that says, jump back in, buy more, that voice gets really, really loud. That's not logic talking, that's pure euphoria. Okay, now look at this. This chart lays out that whole emotional roller coaster. And what's wild is that the peak, the moment of euphoria when everyone is giddy and buying, that's actually the point of maximum financial risk. And the absolute bottom, when everyone is panicking and selling in despondency, that's the point of maximum financial opportunity. We are literally wired to buy high and sell low. So the first big takeaway is realizing the market is basically a machine that's perfectly designed to play on our emotions. Just knowing that is a huge first step. But what if we could go further? What if there were tools to help us map this emotional chaos and actually find predictable patterns inside of it? Well, for more than 100 years, that's exactly what analysts have been trying to do. They've been on this quest to create theories, to draw a map for the market's movements, because they believe that even if history doesn't repeat perfectly, its rhymes can be spotted, and maybe even followed. Now, this brings us to a huge debate in finance. On one side, you've got the random walk theory. This basically says it's all unpredictable noise, like flipping a coin over and over. But on the other side, you have trend following, which argues that, nope, within all that noise, there are real, identifiable trends, and they're driven by that collective human emotion we were just talking about. And this is the perfect way to think about trend following. Just picture a market trend like a giant boulder rolling down a hill. It's probably going to keep rolling in that same direction until some massive force shows up to stop it or change its course. The trick, of course, is figuring out which way it's rolling in the first place. And to help us with that, we're going to turn to the OG of trend followers, Charles Dow. Yep, that Dow, from the Dow Jones Industrial Average. Way back around the turn of the 20th century, he laid out a few key ideas that became the bedrock for pretty much all modern technical analysis. So, let's start decoding these trends. Dow basically gave us a new language, a way to interpret what the market is telling us by breaking it all down into trends and phases we can actually recognize. And he used this amazing analogy, the ocean. He said the most important trend is the primary trend. That's the tide. It's the big, powerful, long-term direction of the market. Now, within that tide, you have secondary trends, which are like waves that pull back against the tide. Those are corrections. And finally, you've got the minor trends, just the little daily ripples and noise that can drive you crazy if you focus on them too much. And this chart just shows it perfectly. You can see that long primary uptrend. That's the tide coming in. But all along the way, you see these clear secondary waves pulling back. And if you could zoom in really close, you'd see all the tiny, minor ripples day to day. Dow's advice was simple. Always, always pay attention to the tide, not the ripples. Dow also saw that these big trends have a kind of predictable life cycle, and they unfold in 3 psychological phases. It all starts with accumulation. This is when the really smart, informed investors start buying up assets when the news is awful and nobody else wants them. Then comes public participation. That's when the good news starts trickling out and the general public finally jumps on board. And it all ends with distribution. This is where those early investors quietly start selling their shares to a crowd that has become totally, wildly euphoric. And you can literally see these phases on a real chart. Take a look at the bottom left. That's accumulation. Prices are in the gutter, everyone feels terrible, but the smart money is moving in. Then, way up at the top, you see the distribution phase. Prices are peaking, everyone's bragging at cocktail parties, and those same smart investors are quietly heading for the exit. But here's the thing. Just thinking you see a trend isn't enough. For Dow, maybe his most important rule was confirmation. To make sure you're not getting faked out, you need different pieces of evidence to all tell you the same story. And his big one was this: the averages have to confirm each other. He looked at the industrial average, the companies making all the stuff, and the transportation average, the companies moving all that stuff. His logic was simple. For the economy to be truly healthy, both have to be going up. I mean, if factories are churning out more goods, but the shipping companies aren't moving them, something's broken, right? This chart shows what happens when they don't agree. This is called a divergence. See how one average is hitting new highs, but the other one just can't keep up? To Dow, this was a massive red flag. It was a clear warning sign that the whole trend was losing steam and might be about to turn over. So, Dow theory gives us this really logical way to look at trends. But what if the real secret isn't just about following the trend, but about actively betting against the crowd's emotions? And this brings us to a powerful idea that takes us right back to where we started this whole journey. It's called contrarian theory, and it's built on one simple, powerful idea. The crowd, the so-called herd, is almost always wrong at the big turning points. So a contrarian investor is someone who is actively looking for those moments of extreme excitement or extreme panic, and then does the complete opposite. And this brings us completely full circle. Remember that emotional cycle chart? The contrarian is the person who sees that moment of despondency when everyone is panicking and giving up and gets excited, because for them, the point of maximum fear is the point of maximum opportunity. They're the ones doing the buying during that accumulation phase Dow was talking about. So what does this all mean? Well, theories like Dow's give us a logical map for trying to understand the market. But maybe, just maybe, what they really are tools for reading human psychology on a massive scale. And that leaves us with one last question to think about. When we look at a stock chart, are we really analyzing numbers and data? Or are we just tracing the timeless, ancient rhythm of our own collective hopes and fears? We've all seen the explosion of AI, right? Tools like ChatGPT are doing things that feel like science fiction. So of course, the big question on everyone's mind is, can we finally use this incredible power to crack the code of the stock market? Let's dive in and see. I want to start with this quote because it really gets to the heart of our whole conversation today. It's not about us versus the machines. It's about us with the machines. Just tuck that idea away for a bit. We're going to come back to it, and you'll see just how true it is. So here it is, the billion-dollar question. I mean, we've seen AI write poetry, create incredible art, debug code. So the next logical step has to be using it as a financial crystal ball, right? To tell us exactly where a stock is going. But, is that even the right way to think about it? But before we get too carried away with that idea, we need to hit pause for a quick and kind of surprising reality check. Because it turns out, even the most advanced AI doesn't always get better and better. Okay, check this out. This is from a Stanford study. In just 3 months, they found that GPT-4's ability to execute some code correctly plummeted from a decent 52% all the way down to a jaw-dropping 10%. This tells us something absolutely critical. AI is not infallible. Its performance can actually get worse. And this right here shines a huge spotlight on AI's biggest weakness when it comes to the markets, what we can call the prediction problem. And you know what? You don't even have to take my word for it. Just ask the AI itself. Look at this. When you ask ChatGPT to predict the price of the S&P 500, it tells you, straight up, I'm sorry, but I am not able to make predictions about financial markets. The machine itself knows its limits. So why? What's going on here? Well, it all comes down to understanding the difference between two very different jobs, prediction versus classification. Prediction is trying to answer, what will the exact price be? That's incredibly hard. But classification, that asks a much more manageable question. Is the market generally going up or is it going down? And that is something AI can actually get its head around. Trying to predict an exact price is, let's be honest, a fool's errand. The market is just this swirling vortex of chaos. You've got politics, the economy, what traders are feeling that day, some totally random news story that breaks, and all of it is smashing into each other in ways you just can't foresee. It's pure chaos theory. And hey, this isn't some newfangled idea. Researchers were pointing this out way back in 2008, saying, yeah, predicting price movements is quite difficult. So if prediction is a dead end, what's the right path? This brings us to a much smarter goal. We need to shift our whole mindset away from trying to be a fortune teller and towards the much more practical skill of trend spotting. And this is the world of technical analysis. It's not about magic or knowing the future. It's about looking at what the market has already done, looking at price and volume, to figure out the probabilities of where it might go next. Think of it like trying to spot the main current in a massive churning river. Now, this whole approach is built on 3 big ideas. 1, the current price already reflects all the known news. 2, prices don't move randomly, they move in trends. And 3, history tends to repeat itself, mostly because human emotions like greed and fear haven't changed much over the centuries. And listen to this. Those same researchers from before, they said it perfectly. They said, making money isn't about knowing the exact price. It's about knowing the direction. Are we in a buy environment or a sell environment? That's the whole ballgame. So let's just hammer this point home. We're not using a crystal ball here. We are using a compass. The goal is simply to figure out which way the wind is blowing. Okay, so if the name of the game is trend spotting, where does AI fit back into the picture? Well, this is where we uncover its real superpower. Not as a predictor, but as the ultimate tireless assistant. Here's how this human-AI team-up actually works in the real world. Step 1. A human trader comes up with a clever strategy to identify a market trend. Step 2. They give that strategy to an AI to do something called parameter optimization. This is the cool part. The AI then tests thousands, sometimes millions, of tiny variations of that strategy on historical data. And step 3, using smart techniques like genetic algorithms, the AI finds the absolute best, most optimal version of that human idea. And it does it in a tiny fraction of the time a human could. So you see what's happening? The AI isn't the oracle whispering secrets. It's a ridiculously powerful, high-speed testing machine. It's an optimization engine that can test, refine, and perfect a human's idea at a speed that's almost impossible to comprehend. And this is maybe the biggest takeaway of all. The AI isn't coming up with a strategy from scratch. It's taking a trader's human intuition and making it exponentially stronger, more robust, and more effective. It's an amplifier for our own intelligence. And that brings us right back to where we started. That quote should make perfect sense now, right? The future isn't about AI taking over. It's about the person who learns how to use AI's incredible power to make their own ideas better, faster, and stronger than ever before. So maybe the ultimate question isn't whether a machine can beat the market. Maybe it's about what we can achieve when we combine the best of human creativity with the brute force analytical power of artificial intelligence. What do you think? Have you ever looked at a stock chart and just seen, well, a chaotic, unpredictable scribble? You are definitely not alone. But what if I told you there are tools specifically designed to find patterns in all that chaos? Today, we're opening up the Technical Trader's Toolkit and taking a look at 4 essential instruments for navigating the financial markets. You know, in the trading world, you hear this mantra all the time. Plan the trade, trade the plan. It sounds simple, doesn't it? It's all about discipline, about having a strategy. But it also brings up a pretty big question. Right. How in the world do you make a plan when what you're looking at is this? It's just a jumble of peaks and valleys. It can feel completely random, almost like it's impossible to know what's coming next. Well, that's where a whole field called technical analysis comes in. For decades, traders have been developing these mathematical tools, not to predict the future, but to find recurring patterns in that chaos, helping them make much more informed decisions. Okay, so let's dive in. We're going to frame these sometimes complex ideas as 4 practical tools inside a trader's toolkit. By the end of this, you're going to understand what they are, what they do, and maybe most importantly, how they all fit together. First up, we've got the most fundamental tool of them all, the trend spotter. You'll know it as the moving average. Its main job? To cut through all the short-term noise and show you the bigger picture. So what is it, really? A moving average, or MA, is surprisingly simple. It just takes the average price of something over a specific time, say the last 20 days. And by doing that, it smooths out all the day-to-day jitter, revealing a much cleaner underlying trend. So what does this actually do for a trader? Well, first, it helps him see the general trend. Is the line pointing up? That's bullish. Pointing down? That's bearish. But it also acts like a moving boundary for the price. Sometimes it's like a floor, what traders call support, where the price might bounce. And other times, it's like a ceiling or resistance that can push the price back down. All right, next tool in the box is the momentum gauge. You probably know it as the Relative Strength Index, or RSI. So if the moving average tells us the direction of the trend, the RSI tells us about the energy or the strength behind that move. The RSI is what's called an oscillator, which just means it moves back and forth between 0 and 100. It's calculated using average price gains and losses. But really, all you need to know is that it measures the speed and change of price movements to tell you how strong or weak a trend really is. So here's how traders read it. Think of it like a fuel gauge. When that reading gets up above 70, it's considered overbought. Kind of like a car engine running in the red, it might be due for a cool down. Below 30, it's oversold, like a compressed spring, just waiting to bounce back. But the most powerful signal it can give is something called divergence. Okay, let's break this down because it's really important. Over on the left, we have bullish divergence. See how the price chart makes a new low? But look down at the RSI indicator below it. It actually makes a higher low. That's a huge clue that the downward momentum is running out of steam. And on the right, it's the exact opposite. Price hits a new high, but the RSI can't keep up. That's a bearish divergence, and it's a major warning sign that an uptrend might be about to reverse. Let's move on to our third tool, which actually builds on what we just learned. This is the signal light, or the MACD. It takes that whole idea of moving averages and turns it into a tool that gives you more direct trading signals. MACD stands for Moving Average Convergence Divergence. I know, it sounds super complicated, but the idea is pretty simple. It just takes 2 different moving averages and tracks the relationship between them. This creates 2 lines that you see on the chart, the main MACD line and a signal line, and really all you need to watch is how they interact with each other. So how do you read it? It's all about the crossover. When that main MACD line crosses above the dashed signal line, that's generally seen as a bullish signal, a potential time to buy. And when it crosses below, well, that's your bearish signal. And just like the RSI, it can also show you divergence, giving you yet another clue that a trend might be getting tired. All right, our final tool is a little bit different. Meet the volatility meter, or the average true range. Now, this tool doesn't care one bit about price direction. Up, down, sideways, it doesn't matter. It only cares about how wild or how calm the market is at any given moment.
The average true range, or ATR, is a pure volatility measurement. It calculates the average true range of price movement. So in plain English, a high ATR reading means prices are swinging around like crazy. A low ATR means the market is quiet and calm.
Let's look at a real chart to see this in action. The candlesticks at the top are the price, and that line way down at the bottom is the ATR indicator. Notice the spots where the ATR line spikes way up? That means volatility is exploding. Now look directly above those spikes on the price chart. You'll often see that they line up with major market tops or bottoms. Extreme volatility can be a sign that a trend is exhausted and getting ready to turn over. So why does this even matter? Well, its most important job is in risk management. Because the ATR tells you how much an asset typically moves, traders use it to set intelligent stop-loss orders. It helps them place their exit point far enough away to avoid getting shaken out by normal market noise, but still close enough to protect their capital if they're wrong. And here's a fantastic practical example. This chart is showing something called a chandelier exit. See those dotted lines trailing the price? Those are stop-loss levels that are calculated using the ATR. Look closely. When the market is calm, the line is tight to the price. But when things get choppy and volatile, the line automatically moves further away, giving the trade more room to breathe. It's a stop-loss that literally adapts to the market's mood. Okay, so we have our 4 tools: the trend spotter, the momentum gauge, the signal light, and the volatility meter. But here's the secret. The real skill isn't in just using one of them. It's about combining them to build a complete, coherent framework for looking at the market.
Here's how a trader might put it all together. First, they use the trend spotter, the moving averages, to get the main direction. Are we going up or down? Second, they check the momentum gauge, the RSI, to see how strong that trend actually is. Third, they watch the signal light, the MACD, waiting for a crossover to help time their entry. And finally, once they're in the trade, they use the volatility meter, the ATR, to set a smart stop loss and manage their risk. See how it's a process?
And this brings us to what is, without a doubt, the most important takeaway of this entire explainer. None of these tools is a crystal ball. They don't predict the future. They can't. Their whole purpose is to help traders manage probabilities and make disciplined, informed decisions instead of just emotional guesses. And that is the key right there. While every tool we've talked about is valuable, any single indicator can and will give you false signals. A really solid approach combines multiple tools to get a much more complete picture of what the market is actually trying to tell you. Which leaves us with one final big question. You now know the mathematical tools, the inputs, the frameworks. But putting it all together in a live, dynamic, ever-changing market, well, that requires interpretation, experience, and intuition. So what do you think? Is trading a science, or is it an art? You know, most traders, they're just glued to their price charts. But the pros? They're trying to read the market's mind. So today, we're going to crack open their toolkit and show you how to start decoding market psychology and spotting those big trends before they even happen. And you really have to start with this legendary quote from Warren Buffett. It's the ultimate contrarian mantra, right? It just perfectly captures the biggest challenge every single trader faces: managing emotion. Sounds easy enough, but actually doing it, that's one of the hardest things in the world. And that really brings us to the big question, doesn't it? How can you possibly stay objective? How do you make logical calls when it feels like the whole market is just swinging between crazy euphoria and absolute panic? Well, the techniques we're about to get into are designed to give you exactly that, a logical edge. So here's what we've got on tap. We'll start by talking about the art of trading against the crowd. Then we'll jump into 3 really powerful techniques: using relative strength to find the market leaders, checking the market's vital signs to see its true health, and then decoding Bitcoin's unique built-in clock. And finally, we'll put it all together into your new pro-level toolkit. First up, let's talk about trading the crowd. The core idea here is actually pretty simple. The biggest, juiciest opportunities often show up when you're willing to go directly against what everyone else is thinking and feeling. So how do we do that? Well, we're going to zero in on 3 specific, advanced methods that the pros use to get a much clearer picture. We've got relative strength, which tells us who the real leaders are. Then there's market breadth, which is kind of like an X-ray of the market's internal health. And finally, seasonality, which helps us spot these amazing recurring patterns. All right, let's get into our first technique, relative strength. This isn't just about figuring out what's going up. It's about finding the real leader of the pack. So how does this actually work? It's surprisingly simple. We just create a ratio by dividing the price of one asset by another. If that ratio line is trending up, it means the first asset is outperforming. If the line is falling, it's weaker. It's a straight-up, head-to-head performance battle. Okay, check this out. This is where you can see just how powerful this is. In the top panel, you see Apple's stock price hitting new highs. Everything looks fantastic, right? But the bottom panel, that tells the real story. Its strength compared to the S&P 500 is already starting to drop. This divergence was a huge, blinking warning sign of the weakness that was about to come. Now, this idea isn't just for stocks. Nope, it's actually even more powerful when you apply it to the world of crypto. See, in the crypto universe, Bitcoin is the big benchmark, kind of like the S&P 500 is for stocks. So on the left, you've got the value of the entire crypto market. And on the right, that's just Bitcoin's piece of the pie. The relationship between these two, well, that's everything. And that relationship has a name, Bitcoin dominance. It's simply Bitcoin's market cap as a percentage of the total. And this one metric tells this amazing story of how the crypto market has evolved, from back when Bitcoin was the only game in town to now with thousands of altcoins in the mix. And this chart just lays it all out perfectly. There's this fascinating inverse thing that happens. When Bitcoin's price is rallying and confidence is high, traders get bolder. They start to take on more risk, moving money out of the relative safety of Bitcoin and into altcoins, chasing those faster, higher profits. This is why Bitcoin's dominance can actually fall even while its price is going up. The best way to think about this is gold versus silver. Bitcoin is like digital gold. It's the lower risk, safe haven crypto. Altcoins, they're like silver, much more volatile, higher risk, but also built for potentially higher returns. This makes Bitcoin dominance a fantastic risk-on, risk-off indicator for the entire crypto market. When that dominance starts to fall, it means investors are feeling confident in taking risks, a pretty bullish sign for the whole space. All right, let's move on to our second technique, checking the market's health. This is all about looking under the hood to see if a rally is the real deal or if it's just running on fumes. Think of a market index, like a sports team. You wouldn't just look at the final score to see if the team is strong, would you? Of course not. You'd want to know how the individual players are performing. Well, market breadth does exactly that. It checks to see how many individual stocks are actually participating in a rally. So here's a classic example, the advanced decline line. Up top, you see the S&P 500 index chugging along, but the real story is down below. That line tracks the net number of stocks rising versus falling. A healthy trend needs broad participation. You want to see a lot of individual players pushing the team forward, not just one or two superstars carrying all the weight. And listen, the analysis goes way, way deeper than just that one line. Professionals use a whole battery of these kinds of tests, looking at everything from new highs to which stocks are above key moving averages. You don't need to memorize all of them. The big idea here is that each test just adds another layer to the diagnosis, creating a complete health check of the market. Okay, our final technique is super interesting and totally unique to crypto. We're talking about understanding Bitcoin's clock. And this isn't about holidays or weather patterns. This is a predictable 4-year cycle that is literally programmed right into Bitcoin's code. First, let's just talk about seasonality in general. All it means is that markets tend to have these predictable patterns. For stocks, you might hear about the Santa Claus rally around the holidays. But for Bitcoin, the engine driving its seasonality is way more fundamental. And it's mathematical. And that engine is called the halving. It's written right into Bitcoin's DNA. Roughly every 4 years, the reward for mining new blocks of Bitcoin gets sliced in half. This means the pace of new Bitcoin being created slows down, which systematically increases its scarcity over time. It's basic supply and demand. And this is the result. I mean, just look at this chart. It's incredible. These vertical dotted lines, those mark the halvings. And just look at the powerful, repeating pattern that plays out every single time. You get a period of accumulation, then a massive bull market rally, that's the green, followed by a bear market correction in red, which leads right into the next halving. It's this clear, observable cycle, like clockwork.
So we've just walked through 3 incredibly powerful techniques. Now let's wrap it all up and put them together into a professional toolkit that you can actually start using. The real magic happens when you start layering these tools on top of each other. So first, you use relative strength to find out who's really in the lead. Second, you pop the hood and check the market breadth to confirm if that trend is actually healthy. And finally, you use Bitcoin's clock to understand the larger cycle you're operating in. This combination gives you this amazing, multi-layered view of the market. And that leaves us with one last thought. These tools show us that underneath all the chaotic, day-to-day headlines, markets often have a deeper rhythm, a hidden structure. So the real question is, are you equipping yourself to listen to that music, or are you just getting lost in the noise?
So, you've probably heard about trading bots, but how do they actually work? How does a bunch of raw data get turned into a system that can trade, completely on its own? Well, today, we're going to pull back that curtain and tear the whole process down. Let's dive in.
But first, a word of warning, and it comes from this great quote. In the world of quant trading, it's so easy to just stare at data until you see a pattern that you want to see. If you torture it long enough, sure, it'll confess to just about anything. But that's not a real strategy. That's just noise. Our goal isn't to force the data to talk, it's to find a real, logical, and statistical edge. All right, so here's the game plan for today. First, we're going to get into the right mindset for this stuff. Then, we'll talk about why you should think of strategies as tools in a toolbox, not as crystal balls. We'll dive deep into 2 majorly different approaches, riding the trend versus hunting for reversals. After that, we'll see how big data can give you a massive advantage. And to wrap it all up, we'll walk through a roadmap for building your very own automated system. Okay, first section. Before we even think about code or complex math, we have to start with the most critical tool you have, your mindset. Seriously, success here isn't about being a fortune teller, it's about a complete shift in how you look at the markets. And this really is the fundamental choice you have to make. Are you trying to be Nostradamus, predicting every single move, or are you the casino? So many traders fall into that trap of trying to be right every time. But that's not the game. The real game is to be the house. Think about it. A casino has no idea if you're going to win the next hand of poker. But they know with mathematical certainty that over thousands and thousands of hands, their small statistical edge will make them profitable. That right there is the quant mindset.
So this is the whole mission, boiled down. First, develop a strategy that has a provable statistical edge. Then, and this is the hard part, build a system that can execute it flawlessly, again and again, with zero fear and zero greed. That's how you play the long game.
Okay, so our mindset is in the right place. Now it's time to start filling our toolkit. A huge mistake people make is looking for that one single magic bullet strategy that works all the time. But that just doesn't exist. It's way better to think of this as collecting a set of specialized tools, where each one is designed for a very specific job. So just to make sure we're all on the same page, what exactly is quantitative trading? You can think of it as being a detective who uses math and data as their magnifying glass to find clues in the market. It's all about identifying opportunities based on numbers, not on a gut feeling. The entire goal is to build a system that is completely objective.
And this doctor analogy is just perfect, right? A doctor doesn't prescribe the same medicine for every single illness. First, they diagnose the patient. A skilled trader does the exact same thing with the market. They check its vital signs. Is it in a strong, healthy trend, or is it choppy and volatile? And only after making that diagnosis do they reach into their toolkit and pull out the right remedy, the right strategy for that specific condition.
So let's open up that toolkit and look at 2 powerful, but basically opposite strategies. This is the classic matchup. Do you ride the wave with trend following, or do you try to catch the turning of the tide by hunting for reversals? Okay, first up for the trend followers, we have the Triple Exponential Moving Average, or TEMA for short. Now, don't worry about the complex name. Just think of it as a really strict filter. Its job is to ignore all the random market noise and only pay attention to strong, clear trends.
It only gives a signal when 3 different indicators are all aligned and pointing in the same direction.
So why is that so important? Well, because every single trade you make costs money, in commissions and in something called slippage, which is where the price moves against you before your order gets filled. By being super selective and taking fewer but higher quality trades, you're not just trying to win more often, you're actively cutting your costs and making your entire operation more efficient.
Now, let's completely flip the script. On the other side, we have the false breakout finder. Instead of riding the trend, this thing is a predator. It's actively hunting for signs of weakness and exhaustion. It looks for that exact moment when the market tries to push to a new high or a new low, but it just fails. That failure is often a massive clue that the trend is running out of gas and a reversal could be right around the corner. Here's another tool for the reversal hunters. It's called the Range Volatility Spike Indicator. Now, this one isn't looking at price levels at all. It's looking at the sheer size of the price swings. You can think of it like a seismograph for the market. A sudden, massive spike in volatility often signals that there's either panic or euphoria in the air. And those moments of extreme emotion often happen right at a major turning point.
So, to sum it up, you've got these 2 very different paths. You can be a trend follower, using a tool like TIMA to ride those big, powerful waves, or you can be a reversal hunter, using tools like the FBF and RVS to pinpoint market exhaustion. And listen, neither one is better than the other. They're just different tools for different kinds of market weather. The real skill is knowing which one to use and when.
So far, we've been looking at tools for just one stock or one asset at a time. But what if we could upgrade our toolkit to analyze the entire market all at once? This is where we go from a single instrument focus to a true big data approach.
This brings us to a really game-changing question. When you look at an index like the S&P 500, you're kind of looking at a forest from a helicopter. You see the overall green canopy, but you have no idea what's happening with the individual trees. So what if you could get a much more accurate picture by analyzing every single stock inside that index? Well, the answer is a huge, resounding yes.
This is called market breadth analysis, and it's all about looking at the individual trees to understand the true health of the entire forest. So instead of just tracking the S&P 500's price, you're analyzing all 500 stocks. Are more of them going up than down? Are the majority of stocks overbought? This gives you a much clearer picture of the market's real underlying strength or weakness.
And the results? They're pretty stunning. Just look at this chart. The orange line shows a market breadth strategy over a 10-year period. It didn't just beat a simple buy and hold strategy, that's the yellow line, it absolutely crushed it. And it left those traditional single indicator strategies in the dust too. It's not even a fair fight.
Remember that casino edge we talked about at the beginning? This is what it looks like in the real world. Over a decade, for this strategy, the average winning trade was 1.55 times larger than the average losing trade. That's not a prediction. That's a proven mathematical advantage playing out over thousands and thousands of trades. All right, we have covered the mindset, the tools, and the power of big data. Now, it's time for the final piece of the puzzle. How do you actually put all of this together into a system that trades for you?
The whole process really boils down to these 6 steps. First, you have to define everything, your entry rules, your exit rules, and most importantly, your risk management. Second, you identify the specific signals you're going to use. Third, you have to code those signals so a computer can recognize them in real time. Fourth, and you absolutely cannot skip this one, you test everything. You backtest it on historical data, you test it in a demo account, you test. Fifth, you build the actual automated system. And finally, step 6, you monitor its performance and you refine it, because no strategy works perfectly forever. The markets always change.
And all of this brings us to a really fascinating question for the future. As the machines get better and faster, what's left for us humans to do? What's our new edge? Is it the creativity to design new strategies? Is it the wisdom to know when to override the system? Or maybe, is it just having the discipline to let a good system do its job? That's the real challenge for the next generation of traders. Thanks for joining me. All right, let's get into it. Today, we're diving into something that pretty much every systematic trader is after, the so-called Holy Grail. But what if I told you the real secret isn't some magic formula you find, but a process you build? Let's break that down. You know, ever since markets have existed, people have been hunting for that one perfect system, right? A secret strategy that just prints money no matter what's happening. This whole quest for a holy grail is a really powerful idea, but honestly, it usually just sends people looking for a perfect answer that doesn't exist. And that's where this quote from Douglas Adams just hits the nail on the head.
See, instead of searching for some universal answer, the real skill in trading is learning how to ask the right questions about the market and about your own ideas. It's about a total mindset shift from hunting for a secret to building a process.
So that's the real problem, isn't it? If there's no single perfect strategy, how in the world do you build up the confidence to actually trade an idea? How do you go from just having a hunch to having a system you can actually trust with your capital? Well, that is exactly what we're going to unpack.
So, where do we even start? Well, it all begins with testing your idea. Before you can even think about fine-tuning a strategy, you first have to prove that the basic concept has any merit at all, and you have to do it with data.
And the main tool we use for that is something called backtesting. Think of it like a simulation. You take your trading rules, you feed it a whole bunch of historical data, prices from last year, the year before, and so on, and the computer shows you exactly how your strategy would have performed. It's pretty much the closest thing we have to a time machine for our trading ideas.
And the reason this is so important is, well, it's the whole point of quantitative trading. The entire goal is to take human emotion out of the picture. We're talking about fear, greed, hope, panic, all of it. Instead of making gut decisions, you're making choices based on what the data shows has actually worked in the past.
So, what does a testable rule even look like? Well, here's a super simple example. Step 1 could be a trend filter. Are we generally moving up? Maybe we check if the price is above its 200-day average. Step 2 is our actual signal. Has a short-term average crossed over a medium-term one? Now if, and only if, both of those things are true, the system says buy. That's it. It's all logic, zero emotion.
Okay, so backtesting tells us if an idea might have worked in the past. But the next logical question is, could it have worked even better? And that's where we get into finding the optimal settings.
This next step is called optimization. You see, pretty much every strategy has these little inputs or parameters, like the length of those moving averages we just mentioned. Optimization is just the process of testing hundreds, sometimes thousands, of different combinations of those settings to see which one would have given you the absolute best results on that historical data.
And visually, that search for the best settings can look a lot like this 3D chart. Every single point on this surface is one test run with a unique combination of settings. The height of the surface is the profit. So that highest peak right there, that's what we call the global optimum. It's the single most profitable combination the test could find.
Now, finding that highest peak seems like the obvious goal, right? You'd think, just pick that one. But here's where things get really, really interesting. The absolute most profitable result from a backtest is not always the one you want to go with for the future.
And this shows us a really crucial insight. It's not just about finding the highest peak. What you really want to find is a broad, stable plateau of good results. And why is that? Well, because a single, really sharp spike suggests that the great performance was kind of a fragile fluke. It only worked with those exact settings. But a wide plateau suggests the strategy is robust. The core idea works pretty well across a whole range of similar settings, and that gives you way more confidence that it wasn't just a random statistical accident.
I know this all might sound a little bit abstract, so let's make it way more concrete with a real-world case study. We're going to look at a popular momentum indicator, the MACD, and see how it performed on 1 year of Bitcoin data.
So first, we need a starting point, a baseline. This chart here shows the test of 20 common strategies on Bitcoin. And what do you know, right out of the box, using just its standard default settings, the MACD strategy was the best performer during this 1 year period.
So, just how well did it do? Well, with its default settings, the strategy returned 1,151%. Yeah, an absolutely incredible result. But believe it or not, that's just our starting point.
I mean, that's a wild number by any standard. But it immediately brings up the next question. That was with the default settings. What happens if we try to find the truly optimal settings for that specific market and that specific time period?
So that's exactly what happened next. An optimization test was set up to check every single combination of the indicator's main parameters within a certain range. All told, this one optimization ran 1,836 different backtests to hunt down the best possible combination.
And what was the result of that massive search? Well, the optimized version found a very specific combination of settings that would have boosted that already incredible return all the way up to 1,483%.
Okay, let's just put that side by side for a second.
By running a systematic optimization process, the strategy's historical performance was improved by 332 percentage points. That right there is the power of this process. It's not about finding some brand new, secret strategy. It's about precisely fine-tuning the one you already have to fit the market it's trading in.
And this brings us right back to where we started. The real holy grail of trading, it isn't some secret formula that you're given. It's the process of rigorous testing and refinement itself. It's something you build.
Now, we have to be super clear about this. This is the most important disclaimer in all of finance. Past performance does not guarantee future results. Just because a backtest looks fantastic doesn't mean you found a crystal ball. But what this process does do is give you a data-driven way to potentially improve how well a strategy fits a market.
So let's wrap up with the key takeaways here. First, stop looking for a magic formula and start building a rigorous process. Second, you have to backtest your ideas to see if they have any historical merit at all. Third, you can use optimization to systematically fine-tune them. And fourth, and this is so important, when you optimize, you have to look for those stable, robust plateaus, not the fragile, one-off spikes. And always validate your results on data the strategy has never seen before.
And that leaves us with the final, essential question. This entire process is an incredibly powerful tool for understanding the past. It can show you with amazing precision what did work. But the million-dollar question that every trader always has to face is, how much confidence does that really give you in what will work tomorrow? Thanks for joining us for this explainer.
Have you ever stared at a problem that's just so massive, so complex, that trying to find the perfect solution feels, well, impossible? It turns out nature cracked this code billions of years ago. Today, we're going to explore how the fundamental ideas of evolution are powering a type of AI that can solve these ridiculously hard problems.
Okay, so we've all seen this image, right? It's that classic picture of evolution as this slow, steady march towards something better. And that's exactly what it is. It's nature's ultimate optimization process. It's constantly testing, tweaking, and refining, generation after generation, to find out what actually works.
And this quote from Darwin just nails it. See, evolution isn't really about finding the absolute strongest or smartest solution. It's all about adaptability. It's about finding the solution that is the fittest for one specific situation. Now keep that word fitness in the back of your mind. It's going to be really important later.
So to really get a feel for why we even need a clever solution like evolution, we first have to understand the sheer scale of the problems we're up against. And for that, we're going to turn to a famous thought experiment involving a monkey and a typewriter.
So the theory goes like this. If you give a monkey a typewriter and an infinite amount of time, it will eventually randomly type out the complete works of William Shakespeare. This is what we call a brute force approach, just trying every single possible combination until you accidentally hit the jackpot.
So just picture this little guy trying to find the perfect settings for a Bitcoin trading bot. He's just mashing keys, trying random combinations. I mean, theoretically, he'll find the best one, eventually. But, how long is eventually?
All right, let's put some real numbers on this. We're not even asking for all of Hamlet here. Just this one single 39-character phrase. How long would it take our monkey, typing 1 million random phrases every second, to have a 99% shot at getting it right?
Yeah, that is not a typo. I don't even know how to say that number. It's 9 non-trillion something. It's so big it's practically meaningless. Just for a little perspective, the universe itself is only about 13.7 billion years old. So that whole brute force method of trying everything, for any problem with real complexity, it is completely, totally useless.
So, if brute force is off the table, what's the alternative? We need a smarter way to search for a good answer. And the inspiration for that comes directly from the man himself, Charles Darwin.
Darwin's entire theory really just boils down to these 3 simple but powerful ideas. First, you have heredity. Traits get passed from parents to their kids. Simple enough. Second, variation. Everybody's a little different. And third, the big one, selection. The individuals who are best suited to their environment, the fittest, are the ones who get to survive and pass on their winning traits.
Okay, so here is where it gets really, really cool. We can actually take these principles from biology and translate them directly into a powerful computer algorithm, one that can learn and evolve solutions all on its own.
And here's what that translation looks like. In our algorithm, what biology calls heredity, we call crossover. That's where we mix the traits from 2 good solutions.
Variation becomes mutation, where we throw in tiny, random changes. And selection? Well, that concept was so perfect for what we needed, we just kept the name.
Now, to make all this work, we need a little bit of new vocabulary. A single potential solution, like one complete set of trading rules, is called a chromosome. And each individual setting within that strategy, like maybe the stop-loss percentage, that's called a gene.
So this gives us a whole population of different chromosomes. Each chromosome is a different potential answer to our problem, and the entire population acts like a big gene pool of ideas that our algorithm can play with.
And this is where the magic happens. We take two fit parent solutions and we combine their genes, that's the crossover part, to create a brand new child. And then we might introduce a mutation, just a tiny random change, to introduce some new creative ideas. This is how the algorithm explores the possibilities and gets better over time.
All right, enough with the theory. Let's actually apply this genetic algorithm to a real-world challenge, finding the absolute most profitable trading strategy for Bitcoin.
But wait, how does the algorithm even know what a good strategy is? Well, that's the job of the fitness function. It's just a simple rule that scores every single solution. For our trading bot, the rule is easy. The strategy that makes the most money, the one with the highest ROI, is the fittest. Period.
So the whole process just runs in a continuous loop. Step 1, you create a bunch of totally random strategies to start. Step 2, you test them all and select the best performers to be the parents. Step 3, you create new offspring strategies from those parents. Step 4, you get rid of the worst strategies and replace them with the new ones. And Step 5, you just repeat the whole cycle, over and over again, letting the population get smarter with every single generation.
And now, it is time for the main event. In one corner, we have our slow and steady brute force monkey. And in the other, our fast and intelligent genetic algorithm. Let's see how they do when trying to find the single best Bitcoin trading strategy out of a million possibilities.
First up, the brute force method. It churned through all 1 million combinations. And to its credit, it found the absolute best answer, a strategy that pulled in a 668% profit. Not bad. But look at that time, over 1,200 seconds. That is more than 20 minutes of pure computing time.
Now, in the world of high-speed trading, 20 minutes might as well be an eternity. So the real question is, can our evolutionary approach get us a great answer, but, faster?
And the answer is, oh yeah, a resounding yes. On average, the genetic algorithm found a solution that delivered 650% profit. Okay, so that's 97.2% as good as the absolute perfect answer. That's pretty darn close. But the time? Get this, 1.23 seconds. Incredible.
Let's just let that number sink in for a second. The genetic algorithm was, on average, nearly 4,000 times faster. It found almost the exact same quality of solution in a tiny, tiny fraction of the time. That is the power of searching intelligently instead of just guessing blindly.
And that, right there, is the crucial takeaway from all of this. We don't always need the single, mathematically perfect solution. A lot of the time, a good enough solution that you can find quickly is way more valuable. And by copying nature's playbook, we can do exactly that. We can solve problems that would otherwise be computationally impossible. And this really leaves us with a fascinating final thought. We saw it work for finance, but this technique is used for all kinds of things, from designing more efficient jet engines to planning complex delivery routes. It just makes you wonder, what other impossible problems are out there right now, just waiting for an evolutionary solution to come along?
All right, let's get right into it. Today, we're going to look at a really cool case study on how you can use artificial intelligence in one of the craziest markets out there, Bitcoin. The big idea here? Figure out how to capture all that incredible upside while also trying to manage that insane, stomach-dropping volatility that Bitcoin is famous for.
The whole thing kicks off with this killer quote from Sun Tzu, and, it just sets the tone perfectly. In the world of investing, winning first doesn't mean you can see the future. What it means is having a solid strategy, a plan that's built to handle whatever the market decides to throw at you before you risk a single cent. And that, right there, is the billion-dollar question, isn't it? I mean, when an asset can jump up or crash down by double digits in a single day, how do you even begin to make a plan? How do you prepare for a fight when it feels like there are no rules? That's exactly what we're going to unpack.
So to really get the solution that's being proposed here, we have to first get a deep appreciation for the problem. And with Bitcoin, that problem is the classic age-old story of massive risk versus massive reward.
It's a feeling that anyone who's ever even thought about buying crypto knows deep down. You see these incredible stories of massive gains, and you're drawn to that potential. But you are also terrified of the stories of people losing everything. You want the reward, but that risk, man, it is always staring you right in the face.
And wow, this chart just says it all. What you're seeing here are the annual drawdowns for Bitcoin. That's the drop from a peak all the way down to the bottom for each year. Just look at those blue bars. We're talking drops of 50, 60, even over 80%. Trying to hold on through that kind of chaos is just incredibly tough, not just on your wallet, but on your nerves.
So when you're staring at that kind of risk, how in the world could you engineer a better way to do things? Well, this is where the whole concept of the Bitcoin AlphaBot comes into play. So what is this thing? Well, at its core, it's a completely automated trading system that's powered by AI. But here's the most important part, the real key. Its goal isn't just to make the most money possible. The goal is to maximize risk-adjusted returns. That means it's specifically built to make money from those big upward trends while actively trying to sidestep those massive sell-offs we just saw.
I absolutely love this analogy because it makes perfect sense. This is the entire philosophy of the system. What does it mean? It means, yeah, you want to be there for the good times, the big rallies, but you've always got to be ready to leave the second the party starts to get weird. You're participating, but you're keeping your risk in check by being ready to head for the exit at a moment's notice.
Now, the name AlphaBot has a super important word in it, alpha. See, in the investing world, if you just buy and hold Bitcoin, you get the market's return. That's called beta. But alpha is the extra return you generate on top of just holding on. So the whole point of a system like this is to actually beat the market, not just go along for the ride.
Okay, so stand by the door, generate alpha. It all sounds great in theory, right? But how does it actually work? Let's pull back the curtain and look at the actual strategy the AI is using.
The brain behind the AlphaBot is a fascinating kind of AI called a genetic algorithm. And the way it works is, honestly, it's pretty wild. It basically copies the process of natural evolution. The AI creates thousands of different trading strategies, tests them all against years of historical data, and then only the fittest, the ones that make the most money with the least amount of risk, get to survive and, create the next generation of strategies. It's literally survival of the fittest, but for trading.
And the strategy that this AI eventually evolved into is actually super simple, which is what makes it so smart. Part 1, find and ride the big, powerful upward trends. Part 2, and this is the critical bit, is to avoid everything else. And that doesn't just mean dodging the big crashes. It also means staying completely out of the market during those boring, quiet, choppy times where you can get slowly bled dry by a bunch of tiny little losses.
So how often is this system actually at the party? You ready for this? The data shows that since 2015, the system has only been invested in Bitcoin 14% of the time. Let that sink in. That means for the other 86% of the time, it's just sitting on the sidelines in cash, being patient and waiting for that perfect pitch.
And the power of that number, only being in the market 14% of the time, is just huge. That is how it stands by the door. It's not just about sidestepping those epic crashes we all fear. It's also about avoiding what traders call the death by 1,000 cuts. That slow, painful drain on your account that happens when the market isn't really going anywhere.
All right, now for the moment of truth. A cool strategy is just a story until you see the numbers. So let's look at the data and see if this super selective AI approach actually delivered the goods.
Let's start with a recent year, 2023. That blue line is what you would have made just buying and holding Bitcoin, and it was a great year, up 156%. Fantastic. But the black line, that shows the return for the AlphaBot strategy. It ended the year up 351%. That huge gap between the black line and the blue line, that, my friends, is the alpha we were talking about earlier.
And when you look at the longer-term data going all the way back to 2015, the numbers are just as mind-blowing. A cumulative return of over 13,000%. It's had a winning year almost 89% of the time. But look at this last part, because this is the secret sauce. The average winning month is a gain of almost 14%. The average losing month? A loss of less than 4%. That imbalance is everything.
Okay. Those returns are absolutely eye-popping. But we already established returns are only half the story when it comes to Bitcoin. The real test, the true test of any trading system is how did it handle the risk? What did the downside look like?
And here it is. This right here is probably the most important slide in this whole breakdown. We're looking at that same scary drawdown chart from before, but now we see the AlphaBot's drawdowns in black. Just look at the difference. Year after year, the system's drops are just a fraction of what you would have gone through just holding Bitcoin. This is what standing by the door actually looks like on a chart.
Now here's something that might surprise you. The system isn't about winning all the time. In fact, it only wins on about 40% of its trades. And this is such a huge lesson for anyone who trades. Having a high win rate means nothing if your few losses are big enough to wipe you out. For the AlphaBot, the average winning trade is 3.6 times bigger than the average losing trade. That's called a payoff ratio, and it means the system can be incredibly profitable even while losing more often than it wins.
So finally, how do you even measure if a system like this is successful? A lot of people use something called the Sharpe ratio, but there's a problem with that. Sharpe punishes all volatility, whether it's up or down. But wait a minute, for a system that tries to catch big trends, upside volatility is exactly what you want. The Sortino ratio is a much better tool here, because it only penalizes you for downside volatility, the bad kind. It's just a smarter way to measure the performance of a strategy like this.
So let's tie this all together. What are the big takeaways here? First, Bitcoin offers massive potential, but the risk is very real and can be absolutely devastating. Second, the AlphaBot's whole game is to be incredibly selective, to stand by the door. Third, that selectivity means it's only in the market about 14% of the time. And finally, the historical data seems to show that this approach has led to much higher returns and much lower drawdowns than just buying and holding.
And that really brings us to the final question, the big idea to think about. Yeah, this has been a look at one system in one market, but it points to something much, much bigger. In a world that just keeps getting more complex and more volatile, is the future of smart investing not about being in the market 24/7, but about building intelligent systems that can wait patiently for the perfect moment and, more importantly, protect us from the worst? Is the best investor of the future an AI that knows exactly when it's time to leave the party?
So, here's the big question. Could a new Bitcoin bull market already be underway? Well, according to the source material we're digging into today, the answer is a big yes. In fact, it lays out 5 pretty powerful catalysts that could, just maybe, send Bitcoin rocketing to $100,000 way faster than you think. All right, let's dive into this author's case.
You know, it all kicks off with this really powerful idea from a legendary market timer, Tom DeMark. The whole argument is that a new rally, it doesn't start with good news. No, it starts when all the sellers are just gone, when everyone who is going to sell on bad news has already sold. It's that moment when the market just digs in its heels and refuses to go any lower, no matter how terrible the headlines are. And according to the author, we've seen exactly that play out. I mean, think about it. First, you had the FTX collapse back in November 2022. A total catastrophe, right? But what happened? Within weeks, Bitcoin was actually trading higher. Then Silicon Valley Bank, the go-to bank for so much of tech and crypto, just fails. And the market, it barely even flinched. The author points to this and says, that's it. That's the classic sign. The bull market actually kicked off way back in November 2022.
So here's the core of the whole argument. A new bull run isn't some far-off possibility. It's already here. And it's being supercharged by 5 different things all stacking on top of each other. We're going to break them all down. First, valuation. Then, regulation. After that, the Bitcoin halving. Then this idea of a massive market squeeze. And finally, the big one, the spot ETF, which would basically open the floodgates for institutions.
Okay, first up, valuation. The whole idea here is that if you actually break the crypto market down and look at its individual pieces, it's just, well, it's too cheap to ignore right now.
Now, we've all heard this famous quote a million times, right? And the author uses it to perfectly frame what's happening. The argument is that the market is just being totally irrational, completely undervaluing all the real innovation that's happening in crypto. So let's see how they actually break down the numbers to prove it.
Okay, so when this piece was written, the total market cap for all of crypto was sitting at about $1.13 trillion. And yeah, that sounds like a huge number, but the really interesting part is what's actually making up that number. Check this out.
When you look at the breakdown, it's really dominated by three giants. You've got Bitcoin at $567 billion, Ethereum at $223 billion, and then the stablecoin Tether at $83 billion. I mean, those three alone make up the vast, vast majority of the entire market.
So if you do the math, what's left for everything else? The entire rest of the crypto universe, we're talking thousands of other projects, all the innovation, all the code, all that human effort, is valued at just $257 billion. The author's point is that this number is just ridiculously low for all the potential value being created.
And wow, this chart just says it all, doesn't it? What you're looking at here is the total crypto market cap, but with Bitcoin and Ethereum taken out. And you can see it clear as day. While Bitcoin has been climbing back since late 2022, the rest of the market, it's been totally flat, just sitting there, kind of waiting in the wings because of all the regulatory uncertainty. The author calls it a coiled spring, just waiting to pop.
All right, let's move on to the next two pillars of this argument. These are two huge catalysts that are just around the corner. First, the arrival of actual regulatory clarity, and second, that pre-programmed supply shock we all know as the Bitcoin halving.
You know, a lot of people in crypto are kind of scared of regulation, but this analysis takes the complete opposite view. The idea is that clear rules will finally flush out the bad actors, the FTXs of the world, and more importantly, it'll give the big traditional institutions the green light they've been waiting for. And we all know the old market saying, they're going to buy the rumor long before any final rules are actually announced.
Okay, the next catalyst is baked right into Bitcoin's code. It's the halving. It's this event that's programmed to happen about every 4 years, and it literally cuts the reward for mining new Bitcoin in half, which of course means the supply of new coins entering the market gets squeezed.
And historically, this thing has been a massive, massive driver of the price. Just look at this chart. You can see this super clear, repeating 4-year cycle. There's a huge rally after the halving, then a long, painful bear market, and then this steady ramp up before the next halving. And with the next one coming up in April 2024, the author's argument is that we are smack in the middle of that pre-halving rally phase right now.
Okay, buckle up because this next part is where the thesis gets really explosive. We're talking about the actual market mechanics that could trigger a massive, super fast price surge. They call it the squeeze.
And this classic quote from Warren Buffett just sets the stage perfectly. Because crypto has been so unregulated, this huge market of what are called synthetic products has grown up around it. And the argument here is that when that regulatory tide finally comes in, we're all about to find out who's really been swimming naked.
So what exactly are these synthetic products? Well, the easiest way to think about them is like side bets. They're things like futures or swaps that let traders gamble on Bitcoin's price without ever having to buy or sell the actual coin. A massive amount of trading volume happens in this world, totally off-chain. That just means it's happening on private exchanges and isn't touching the real Bitcoin blockchain at all.
So that leads to the billion-dollar question, right? What happens when new regulations come in? Or what about a spot ETF, which is a fund that, by law, has to hold real Bitcoin to back its shares? What happens when all that demand for paper Bitcoin is suddenly forced to become demand for actual Bitcoin?
Well, this is where it gets crazy. It could trigger a classic short squeeze, kind of like what we all watched happen with GameStop. Step 1. Demand for real, physical Bitcoin just explodes from all these new institutional buyers. Step 2. The limited supply simply can't keep up. And the result? Boom. Prices could just ignite because all the people who were basically shorting the market using those synthetic products are suddenly forced to buy actual Bitcoin at any price just to cover their bets.
And to give you an idea of the scale we're talking about, the author points out that just one company, BlackRock, manages over $5 trillion in assets. So if a spot ETF gets approved, it could unleash a tsunami of institutional money that would absolutely dwarf the entire Bitcoin market as it exists today.
Okay, so with all these different forces all coming together, the author leaves us with one key signal to watch. This is the practical takeaway, the canary in the coal mine that could tell us when the next big move is about to happen.
Let's really break this chart down because it tells a fascinating story. That top line, that's Bitcoin's price, and you can see it's been in a pretty clear uptrend. Now the middle line, that's Bitcoin's dominance, basically its share of the whole crypto market. That's also been rising. But now, look at the bottom line. That's the entire altcoin market, and it's just been dead flat. According to the author, this is a classic sign of cautious, early-stage institutional money coming in. They're dipping their toes in the water, but they're sticking with the big one, Bitcoin, for now.
So here's the punchline.
The signal that the bull market is about to really take off is when we see that bottom line, the altcoin market, finally break out and hit new highs. That's the moment that tells you the risk-on appetite is back across the board. And when that happens, you'll see money start to flow out of Bitcoin and into those altcoins, and that middle line, Bitcoin's dominance, will actually start to fall, even while the whole market is going up.
So to wrap it all up, let's just quickly run through those 5 pillars for a potential run to 100K Bitcoin. 1. Valuation outside of the big guys is historically low. 2. Regulation is coming, and it's going to bring the big money with it. 3. The halving is going to squeeze the new supply. 4. An ETF could trigger a massive short squeeze. And 5. The charts are already flashing the early signals that a new bull run is here.
And in the end, the whole analysis leaves us with this one final provocative thought. It argues that with these 5 incredibly powerful catalysts all lining up at the same time, the question really isn't if Bitcoin is going to reach a new all-time high, it's just a matter of how soon.